please pay close attention, and if you can come past our booth, number 49, with a bit of a critique after this, that'd be most appreciated. Big thanks to Jackson also and the team from Vertical Events for a splendid day yesterday, and I'm sure that we'll have much of the same today. As Chrissy mentioned, my name's Andrew Taplin. I'm the Chief Executive Officer for Heavy Minerals Limited. I've been working in the resource sector for 30 years, developing projects and running operations. I've had the chance to work for the majors. I spent 25 years working for Rio Tinto, worked for a couple of juniors now, and I also worked for an Australian mining contractor with a national footprint. I've had the chance to work in Australia, Canada, the US, and a couple of African nations as well. This morning I'm going to cut straight to the chase. I will put some more flesh on the bones, but the essence of my presentation is four things. We're going to invest about $110 million in a garnet project. We have got a pathway to securing the majority of the CapEx required to develop that project. We expect to be operational by 2026, and the standout feature is that when we're operational, we'll generate almost $40 million a year free cash flow after tax for at least 16 years of mine life. $40 million a year free cash flow after tax for 16 years. Our market cap on Monday was $5.4 million. So I encourage you to do the numbers and have a look at what the upside potential on that is. I should be going ahead, but yeah, I'm pushing it. Okay. Disclosure statement that you can read at your leisure. Any remote assistance possible here? That's got it. Okay, we've got a tight capital structure, as you can see. The top 20 shareholders hold 63% of the shares on issue. Our directors hold 12% of the shares on issue. We have 54 million shares on issue. At the end of quarter one, cash in hand was $900,000, and we've got no debt. Heavy was listed in September 2021 and raised $5.5 million to further explore the three pieces of ground held by the company. And full credit to the team, they've done a great job of delivering on that promise. In Western Australia at the Port Gregory project, a JORC compliant resource of 135 million tonnes at 4% THM. That's total heavy materials has been defined. At Red Hill, just 30 kilometres north of Geraldton, we've recently announced impressive maiden drilling results, and also announced a exploration target. The exploration target's got an inventory of between 90 to 150 million tonnes at 4.1 to 5.4%. Those numbers sound impressive, but to put them into context, the majority of the resource at those two projects is garnet. 90% of the resource at those two projects is garnet, and there's sufficient garnet there to supply the global requirements of garnet for about 10 years, to put that into perspective. At Mozambique also, the team have upgraded the resource there from 59 million tonnes to 90 million tonnes at 3%. All of the resources are quality resources, and all would support development into a going concern mine. The numbers by themselves are impressive, but also another data point is that all of these resources neighbour Tier 1 assets, long life, low cost assets. So the West Australian assets neighbour GMA. GMA have been operating 50 kilometres north of Geraldton for over 30 years and putting a very high quality garnet product into the global market. RDG, the Resource Development Group, heavily backed by Chris Ellison from MinRes, have just stood up a garnet mine, also about 50 kilometres north of Geraldton. And the Mozambican asset borders and neighbours the massive Rio Tinto project in Mozambique as well, which has got 4.4 billion tonne resource. So they're all quality assets. For the last 18 months, Heavy has been an explorer, and we're just transitioning from being an explorer to being a developer. So let me tell you a little bit more about our flagship project at Red Hill. As I mentioned, there are 4 key takeaways, and they all pertain to this particular project. We're going to invest $110 million worth of CapEx. We've got a pathway to securing the majority of that CapEx to develop the project. We expect to be operational by 2026, which is just around the corner, and the project will generate $40 million a year free cash flow after tax. The rest of the financial metrics are on the slide there. As I said, we've got a pathway to funding. For those of you that follow our news flow, on Monday we announced a letter of support from Atritius. Atritius is the Dutch government export credit agency. Since listing in September 21, we've been using IHC Mining for our technical support and for our study support. IHC Mining are just local, they're 20 kilometres up the road at Yatala. And the parent company of IHC Mining is Royal IHC, a company based in the Netherlands. The Royal designation indicates that they're supported by the Dutch government. Royal IHC have been able to advocate for us based on the merits of the Port Gregory project with the Sovereign Wealth Fund, and a letter of support has been forthcoming. Subject to due diligence, all indications are that Atritius will financially support all of the Dutch content of the Port Gregory project. Royal RHC are the largest manufacturer of ocean-going dredges with significant fabrication capability and significant experience building mineral sands plants. So we expect that we'll be able to contract them to bring to the table all of the mining equipment and all of the processing plant equipment, which is a significant proportion of the CapEx. As well as that, we're engaging with Export Finance Australia. They're the Australian export credit agency, and there's also good prospects given that over 90% of our product will be going to international markets, that there's an element of funding that can come out of Export Finance Australia as well. Technically, the project is very straightforward. The garnet is expressing itself at the surface. Maximum depth is about 12 to 14 metres of excavation, and we're mining in a historic sand dune. So this is all free dig, there's no drilling, there's no blasting, this is low cost mining. The flow sheet for the process plant is stock standard mineral sands. It's a wet plant, so we'll do some mag separation. We'll use spirals, and we will screen the product to develop 4 different products for industry use, but very straightforward from a technology standpoint. From an ESG standpoint, the locality of the Port Gregory project is in an established mining locality. As I said, GMA have been operating there for 30 years. RDG have just stood up their mineral sands project, so there's strong social consensus for development of the project, and we're certainly very welcome in the locality. From a market standpoint, there's currently a market deficit. The cumulative average growth rate through until 2030 is expected to be over 7%, and the market deficit is forecast to increase through until 2030, and I'll talk about that in a little bit more detail. But what is garnet and what is it used for? As Chrissy touched on, a couple of the major uses of garnet are for sandblasting, and that is sandblasting of metal surfaces, in particular steel surfaces, before a protective coating is applied. And another major use is for water jet cutting. So the garnet is used to cut metals, but in particular steel, and it does a very precise job of cutting the metals, much more precise than the traditional techniques of using oxy and acetylene, for example. So why is it a preferred material for abrasive blasting in particular? Garnet is a particularly hard mineral. It is 7.5 on the Mohs scale, so to put that into perspective, diamonds is 9 on the Mohs scale. So it's a particularly hard mineral. We will be mining alluvial almandine garnet, and the nature of the particles with alluvial almandine garnet is that they're quite rounded in nature, unlike some other blast media which have quite sharp characteristics to them, which tend to embed in the surface of the metals and cause contamination prior to coating application. So it is the most superior blasting media. Because of its hardness and because of the nature of the particle shape, it's a very productive blasting media, and the consumption rate is particularly low, which means it's a cost-effective blast media. From an ESG standpoint, it generates low levels of dust. It's inert and environmentally friendly, unlike some of the substitutes. So copper slag, nickel slag and coal slag are all used as substitutes for garnet. And from an environmental standpoint, they leach heavy metals into the environment. It is recyclable, and from a workplace health and safety standpoint, it's got minimal to no workplace health and safety risks, unlike some other blast medias such as sand, which generates silica and potentially silicosis for those people that are using that as a blast media. As I mentioned, the flow sheet for the manufacture of garnet is very straightforward, and it's packaged into the packages that you can see there on the right-hand side: 2-tonne bags, 1-tonne bags, and 20-kilogram bags. From a market standpoint, there's currently 100,000 tonne deficit of garnet supply in the global market. That'll broaden to 250,000 tonnes by 2026 when we come online, and 500,000 tonnes by 2030. You can see that between 2015 and 2017 there was a significant reduction in global supply. That was because the garnet mines in India were turned off by the Indian government, and also because of the Hart Range mine in Northern Territory being shut down because of operational issues. So I don't anticipate any issues placing our 150,000 tonnes of garnet into the global market. In terms of some competitor analysis, there's 2 types of garnet. The alluvial garnet that I mentioned, that's indicated with the red marks, and also the green marks is the hard rock garnet, which is less favourable because of the nature of the particles. The hard rock is mined out of the US, and also in China. The alluvial garnet is mined out of India. That market's been turned off, as I mentioned, and also Australia. Australia is the largest producer of alluvial almandine garnet. You can see some of the users there of the blast material. That's it, isn't it? 10 minutes? 10 seconds. 4 takeaways. We're going to invest $110 million. We've got a pathway to funding a large proportion of the capital requirements. Will be operational by 2026. We're to generate $40 million worth of free cash after tax. Please come past our booth. You've got to trip over us on the way there. We'd love to sign you up for our news feed, and also we've got a draw there for some quality West Australian wine. Thanks, Chrissy.